Hello and welcome to Switzer Investing TV. I'm Paul Rickard filling in for Peter Switzer. Peter will be with us shortly with an interview with Michael Knox. Now, Michael is the chief economist with Morgans. He's got some really interesting views about interest rates for next year. Will they go up next year? Well, we'll find out from Michael. And also what that could mean for the Aussie dollar. And if you're investing offshore, thinking about how you might need to hedge or protect your currency could be really important. So that interview in a couple of minutes, that's with Peter and Michael Knox, recorded just a couple of days ago. But first up, I spoke with Michael Gable a little bit earlier about the markets, in particular, his view about some stocks, what the charts are saying, what his fundamental view is saying. Good news for resources, not such great news for some other stocks. Here's Michael Gable, the managing director of Fairmont Equities. Michael, thanks for joining us. Let's start, of course, with the US market, the S&P 500. That looks like a pretty strong rally there.
Yeah, look, it's still trending. There was a bit of a warning sign here. So what I've got for our viewers is a daily chart of the S&P 500. The two blue lines are a couple of moving averages. So we have the 50-day and the 200-day. So, they're closely watched moving averages. So as we could see, since the April low, the US market has held on nicely above that 50-day moving average. And I mean, for our clients, we did have exposure to the Nasdaq with the Nasdaq ETF. The Nasdaq looks pretty much the same as the S&P 500. So we used that as our trailing stop. So we did exit our US positions when it dipped under that blue line.
This is just the other week. This is a couple of weeks ago.
Yeah, just a couple of weeks ago. So we held that for quite a while, to be honest. But look, it has bounced above that blue line. I don't think we're out of the woods yet in terms of the US market. But, the fact that it has managed to bounce back pretty well in the past couple of weeks, is a sign that it may well try to melt higher through to Christmas. So, look, this 200-day moving average is a bit more of a longer-term moving average. So, yeah, if it starts trading for a significant period of time under that, then that's a bit of a danger sign. But look, short-term, longer-term, we've still got the US markets trending on it.
Okay, bottom line, very strong rally, still a bull market intact.
Yep.
Good chance perhaps of a Christmas or Santa Claus rally. Is that sort of where I see it?
That's what it looks like at the moment.
Okay, that's the US market. That's what everything else follows. Let's go to a market that's sort of following but not doing as well. That's our Australian market. Let's look at the S&P ASX 200.
Okay, so similarly, we've got a daily chart here of our market. Just one blue line. This is the 200-day moving average. So obviously our market, especially since mid-October's underperformed the US, we've really fallen away. But essentially what we've got here is our market finding good support at that 200 days. So we've managed to stay above that. Look, there isn't much short-term momentum in terms of what's happened in the past couple of weeks, but it does look like our market is holding above that 200-day moving average. Does look like it's setting itself up for a bit of a recovery from here. So at an index level, I think we've seen the worst of it for our market, and it does look like it wants to head higher.
In addition to being a close watcher of the charts, you're also, you look at things from a fundamental and a qualitative point of view as well. Why do you think our markets have done so badly the last couple of months relative to the US?
Yeah, look, I suppose there are a couple of reasons. I mean, I think the main reason that's caused all this recently is interest rate expectations. Clearly, we have an economy that can't grow more than 2% without inducing inflation. So at the moment, there's a lot of uncertainty as to whether we're going to get rate cuts next year or not. Whereas with the US, we could see they're still on the path for rate cuts. And then the composition of our market, of course, very heavy in banks and resources. Look, I have positive resources, but the banks, of course, are very sensitive to the economy. And
we don't have the AI accelerant that perhaps the US has had. Okay, talking about resources, because they seem to be coming back. Let's go to some resource stocks. We're going to start with Rio Tinto.
Yeah, I think Rio looks very good. We actually initiated some positions in Rio last week for our clients. So we're still quite overweight resources, but we're happy to add Rio. So look, it is a very messy chart. So this is a weekly chart going back almost 10 years. But essentially what we what I
The other chart, if you look at it with daily charts, this is a weekly. This is where we go down it. Almost 2017.
Yep, that's right. So the previous charts only went back 1 year. This goes back almost 10 years. But essentially, what I can see on this chart, even though it's quite messy, is the fact that since pretty much 2021, Rio has been forming a very clear resistance line around these levels here near $135. So what I mean by that is every time it gets near that level, that's where all the selling kicks in for a variety of reasons. But now what we've seen is Rio punch through that level. So previously, where there was a lot of funds or holders of Rio happy to sell at that level, they've now sold out clearly because it's been able to push through that level and it's been able to even trade above $140. So what that means is most likely Rio's going to have a run from here. And because that resistance level has been in place for so long, I don't think the move will just last a few weeks or a few months. I think it'll, I'm expecting a rally from here to last several months.
So powerful,
long-standing
rally for Rio Tinto. So that's a very positive statement for our second biggest miner. BHP is still the biggest, but I guess that would have some effect. Let's go to another company which of course this came out of BHP some years ago. This is South 32, but it's been coming back a little bit the last week or two, but nowhere near as where it was in 2022. So is this a breakout or just a another place to sell South?
No, you've been working on the terminology. It is a breakout. So South 32 also looks positive. This is also one that we bought about a week ago because it looked like it was very close to breaking out above this blue resistance line. So essentially, again, we've had a stock that's been a little bit different to Rio. So where Rio had a horizontal resistance line, and horizontal resistance lines are a bit more reliable, in terms of when you get breakouts. But in the case of South 32, there was a very clear downtrend line, which has now been broken. And I'm expecting a recovery in South 32. So it's
You can put where that might head? We get back to sort of these sort of highs? Is that what anything?
Yeah, that's a real possibility. So I guess, okay, the diagonal resistance line isn't as reliable as the horizontal resistance line. But the fact that we're seeing breakouts, not just in South 32, but in other resource stocks, so across that sector is telling you that there's clearly funds flowing, broadly into resources. And I think the tide will lift stocks like, companies like South 32.
Okay, let's go to another, which is Larry Ellison's mineral resources, which is lithium and iron ore, and a combination of one. This now is back to a daily chart, right?
Yep.
So this is a very strong rebound off some quite horrific stuff in the middle of June there, right?
Yeah, we might have looked at this one, I think, in years. So we identified there was essentially under this blue line, the way it was trading to me resembled a bit of a bottoming pattern, but you generally don't know that's the case until it breaks, breaks above a resistance line. So it did do that. It's now heading higher. The squiggly blue line is a 50-day moving average. And, different stocks have different personalities. And in this case, for whatever reason, Min seems to respect this 50-day moving average very well. So when we've traded it, we've used this as a guideline. We were buying Min as recently as this morning. Okay. I think look, in terms of lithium, I'm not maybe quite as bullish as some of the other resources. I think the whole supply demand dynamics in lithium is still a little bit opaque, but we've been happy to trade these stocks. PLS, we've been in and out. We've been in and out of Min. We're back into Min. I think at the moment it's trading around $51, $52. I think the next resistance level for that is up near $60.
Yeah.
So for any of our viewers that are happy to be a little bit more short term, I'd be happy to buy Min. Use this blue line, the 50-day, as your trailing stop. And I'd be looking at a target close to $60.
Okay, not of blue chip nature, perhaps of Rio in the resource area, because this was down at below $20. So before it goes now over 50, gives you an idea about the volatility, but still quite an endorsement anyhow in terms of those, but higher risk certainly than a couple of the other stocks you've mentioned. Okay, that's resources. Now let's go to one healthcare. CSL still struggling around $180-ish.
Yeah.
Have we seen the bottom in CSL, or what's the chart telling?
Fortunately, the chart is indicating it can go lower. So look, this is one that I've got caught up in as well.
Mm-hmm.
To be honest, I mean, up until this recent drop, we've had this very clear trading range. It bounces off the bottom, good buying, potentially selling up here. It was something I got involved in here towards the bottom, but it did break support. Not only that, but after breaking support, it tried to rally um, to get back above that blue line, but that's when all the selling kicked in and it pushed it lower. So, I've taken my medicine on CSL, and look, it's a great business, and I'm keeping an eye on it. I think at some point it will be a buying opportunity, but clearly they've got issues overseas that they still can't pin down. But based on the way it's trading, it may well get lower. I don't know where.
Okay, so you're not a buyer of CSL?
Not at the moment. No.
Okay. All right. Another company that was all the rage until a couple of months ago, Medicus, I still think is a stock you've got to own, but super expensive.
Yeah.
Has been under a bit of pressure late. Now, what are you looking at Medicus there? Because this was down, this is $180 back in the in April. And we were at below $100 for long parts of last year. So, and we've been as high as 330. So currently 247. What's the chart saying of Medicus?
Yeah, look, it does look like it is heading lower. I mean, this stock's been great for us as well. Obviously, during all that time last year, during this period, we've basically. I'll go back a step. So this blue line is again another 50-day moving average, which I think is a good filter for Medicus. We've used this as our trailing stop. So yeah, it was good to us back here. We were out obviously during all that tariff sort of shenanigans in April. There was a bit of a gift there. So, we were able to have another trade in it. But as we could see now, Medicus, not only is the share price moving lower, but we could see that it's under the 50-day and the 50-day is trending lower. So, I mean, that's seems to be a bit of a symptom of all these, I guess, high PE, technology-related stocks at the moment. Just the market's just not interested in these. I mean, at this price, if this was a year ago, I'd be buying it with my ears pinned back. But clearly, we're in a different market now. The market we could see there's just no buying support yet. So again, I'd rather be out of Medicus, but it's a.
What would it take you to get interested? Would have to sort of find a bit of a base, do some work. Was that
I'd like to see it build a bit of a base. I'd like to see some good buying come in. It probably mean I won't pick the bottom. I mean, back here, you could take that risk because the market was still up.
But only lasted about half an hour, by the way.
That's right. But, I mean, we didn't get the exact low. It wasn't until a couple of days after, but it was still a good price. But yeah, just the market's just not buying these stocks at the moment. So I think if you start seeing Medicus build a base, if you start seeing all the other tech stocks show some obvious support, especially when there's still a lot of skeptics out there, that would be a good sign that, look, I'm happy to stay away from this for now. We've got our resource exposures there trending up. These are trending down. But at some point it'll get to a level where it's worth buying, but I just don't know where that will be.
Okay, let's go to when it comes to technology shortly. But firstly, another stock that's at least in the data center business and many other things is Goodman Group. But it's been under pressure too a bit in the market. That's a funny chart, isn't it? It's sort of like it's not a double top. Is it a double top? I don't know. But what do you give me an idea on Goodman Group, which really has been a blue chip? It's a blue chip.
This used to be a go-to stock for us as well. I mean, we did bail on Goodman Group around here because unfortunately the fact is that during this period of time from around sort of mid last year onwards, it has underperformed the market. And I think, no fault to do with the business. It's a well-run business, low debt, et cetera, et cetera. But I think obviously the market must have, got ahead of itself during this period of time. Obviously, you look at some other REITs like Charter Hall, they've headed higher, whereas Goodman Group, I think it's just gone up too much during that period of time. So in terms of the chart, like a lot of stocks, it fell very sharply around March, April, bounced hard. But usually when you get these V-shaped recoveries, it then needs to consolidate. And if it was going to head higher, it would have gone sideways for a while and then started to make new highs like the rest of the market, but instead it's falling back down, and it's actually not that far off those April lows, which yeah, it doesn't make sense, but that's where it is at the moment. So again, we've got downside momentum. Maybe the buys start to step in near that April low, which could be in the $24s, $25 region. I'm not sure.
Yeah.
But again, it's one on my watch list. But for the moment, there's still the downside momentum.
Okay, let's have a look at some tech stocks that are also maybe out of favor. Let's start with Xero. So Xero raised money at almost $180 or something not so long ago for a big acquisition. We're now $120, so we've lost a third since that capital raising. Not much else has changed, but the market's perception of Xero has changed.
Yeah, so I think that's it. The market's changed. So again, this is one that we've been happy to buy in the past. We're not in it. We were looking to buy it around here at the time of the acquisition. We thought if it got cheaper, I wanted to see a bigger buffer in its valuation, but then it broke the uptrend line and then just continued to fall. So I wouldn't have expected it to be down here. Again, it's a pretty good business, but market's not interested. So
The
market's
market's interested, you're interested, or you're just waiting?
pretty much, yeah. Look, if the market gets interested again, because I mean, I could buy it here, but if it's then going to trade back to $100 and then spend a few months doing nothing before it gets going again, there's all this opportunity cost where I could be making money in South 32 or
Is there anything that tells you, sort of looking at that, as to where you'd expect it to see some good support? Is it around about that $100 level? Yeah, there's a big number. I know. It's a round number too.
Yeah.
There's often markets
that's
tend
right.
to gravitate towards round numbers.
Yeah, that's true. I mean, there is a bit of support at the moment. It doesn't look very strong, but yeah, you're right. I think the next step is that next round number. And we could see at $100, we could see it has been a turning point in the past. So look, maybe at $100, it's almost so cheap that you can't ignore it. But at the moment, every time it tries to have a bit of a bounce, they're still selling.
Okay, we talked about Goodman Group, which is doing a lot in data centers. A pure data center play effectively is NextDC. It's doing a bit more work. It had some good announcements, but it's still well off its high from both sort of back in late last year, isn't it?
Yeah, so this is pretty similar to Goodman Group, unfortunately. Got that sort of V shape, which sort of, where it then fell away again instead of holding up. This is a weekly chart. What's interesting, viewers might not be able to see it, but last week's price action was pretty negative, unfortunately. It tried to rally.
This is an old announcement. That's some good news. So
yeah. And then basically we could see that the market used that good news to sell into it. So it's just telling us it's not ready to head higher yet. In not necessarily a reflection of the business, but that's just the market just seems to have more selling pressure when it comes to next.
Okay, finally to wrap up, in the payment space, a company that sort of is zipping all over the place, but it's had a strong rally and has had a big pullback as well.
Yeah, so what I've got here is a daily chart of Zip. It goes back about a year and a half. Daily chart, and the blue line is a 50-day moving average. So because it's been able to have these sort of big trends, a very nice uptrend here, then quite a substantial downtrend, up again and down again. It means that when you overlay a 50-day moving average, you could see it fits it quite nicely. So, I mean, we can now say this obviously with hindsight that if you bought when it was above the 50-day and sold when it crossed under, you would have been able to pick some good profitable periods. But the fact is that it is heading lower. It is well under the 50-day moving average. Even if we have a look at this bounce here at the end of November, it managed to make up quite a bit of ground over the course of a week, but then most of those gains were eliminated within a couple of days.
And you're not back in Zip yet.
No, I think that, it could, I mean, what we're seeing here could be, what we saw here, which means there might still be substantial downside before it heads higher again. That's just where the buyers and the sellers lay at the moment with Zip.
So sort of wrap that up, Michael, positive about the US, maybe for a bit more continuation of a Santa Claus rally, pretty positive on the resources, particularly Rio and Mineral Resources, Rio South 32.
Yep.
Let's just say Mineral Resources. And then pretty well flat to negative on everything else we've touched on. So that was the tech stocks, the data center stocks, and companies like CSL and so forth. So that's good and bad, I guess, isn't it?
Yeah, that's just our market at the moment. It's yeah, there's a few stocks that are hated, but you mentioned Min, that was hated by almost everybody 6 months ago, and now look at it. So yeah, these things work in cycles, and we're in that part of the cycle where the resources are working and nothing else seems to be at the moment.
Well, that's the way of the market. So thanks, Michael. Some great ideas from Michael Gable. Michael, of course, is the Managing Director of Fairmont Equities. Thanks for joining us, Michael.
Thanks, Paul.
Thanks, Michael. Some great insights. Now, here's Peter with Michael Knox. Michael is the Chief Economist of Morgans. This was filmed just a couple of days ago, but some really great insights about both interest rates and the currency.
Thanks for joining us, Matt. It's great to be talking to you again. Yeah, it is. I should explain. Michael is a chief economist at Morgans. He was once described by Ron Bewley, arguably one of the best academic econometricians this country's ever had, that there's very few econometricians better than you.
Gosh,
Yeah.
well, that was very kind of Ron Bewley, because there are very few econometricians better than Ron Bewley.
Yeah,
Yes.
yeah. And so I've always respected your point of view, because not only do you have an interest, a deep interest in economics, that you go to America, you've debated with Federal Reserve people and all that sort of stuff, but you also can actually add up numbers, which not all economists can do. So
Right.
I'm really happy to have you. But you're here talking to me today because you have a fairly controversial point of view, and I hope you're wrong. But tell us what you think is going to happen to interest rates in the first half of next year.
Well, problem with inflation in Australia is what's happening to electricity prices, and we've seen electricity prices break into giving us an inflation rate of 3.8% this year, when I and a lot of other people thought that inflation could fall to 2.5% by the end of the year.
Yeah.
And the more and more we look at that problem of electricity, it's not an issue of should it be coal-fired or should it be renewable. There just isn't enough electricity. The economy and the demand of electricity is growing so fast that that's going to be a continuing problem. So
Is it things like the unbelievable development of the cloud and data centers and all? Is that a new input into the demand for electricity?
well, it's really a supply problem that, despite the fact that we continue to have increasing demand because of immigration, we have various, in the Hunter, for example, in 2023, very large conventional power station was taken out of the grid. We're just not having enough supply of any kind.
Yeah.
Any kind would be good,
Yeah.
but there just isn't enough of it to support the level of increasing.
And it's funny when you bring this up, and I should share with my audience that Michael comes from the Sunshine State, the great state in the north, Queensland.
Yeah.
And I can remember interviewing a Queensland guy who was associated with coal power, and he said, one day you guys down south are going to start worrying you haven't got enough supply of electricity, and the price is going to go through the roof, and you're making decisions today that's going to cause problems in the future. And he probably said this to me 7 or 8 years ago on my Sky Business program. So a lot of people in the industry realize that this was going to happen, and we're kind of stuck with them.
Yeah, well, all that means, let's put that back to interest rates.
Yeah.
That means we've got a feed-in from high electricity prices to domestic inflation in Australia that we didn't anticipate.
Yeah. But is it so significant in the whole gamut of inflation? All the inputs are going in. Electricity prices has a really big input.
Well, every little business, or most little businesses, use
Yeah.
electricity.
Yeah.
even in the local area that I live in, a bakery that's been there for 25 years has just closed down because the electricity prices are too high for them in that area. So I think that's well, it is a problem everywhere, but all we're talking about here is what it does to inflation. And it gives us higher than anticipated inflation. And the RBA reacts to that by putting up rates.
But people listen to this to say, well, but Michael, how is interest rates going to go up, going to help bring electricity prices down?
It's not about electricity prices bringing electricity prices down. It's about the feed through that higher electricity prices. If there's no increase in interest rates, then the increase in electricity prices will feed directly through to other areas. Other people will push up their prices. Wages will take off to compensate for the higher electricity prices, and all that will feed through a higher level of sustained inflation, of 3 or 4% rather than 2 or 3%.
Yeah. And so, how many interest rate rises do you think the RBA is going to be forced? Because they don't want to do it, but obviously, if they have to do it, they'll do it. How many do you reckon they have in the first half of next year?
Right now, in modelling this, I've got 2 25 basis point rate hikes in the first half of next year.
Do you reckon they'll hang off as long as they can, like maybe even hope the data that comes out? I guess we want the December quarter numbers in February. Would we get the CPI for the December quarter in February?
Well, we're now getting out a monthly CPI.
Yeah. But they're not as good as quarterly still, are they?
Well, what they thought was in the November releases, they'd finally got the monthly number to be as good as the quarterly number.
And that was a crap number.
Yeah, when it was a bad number, it was a scary number. Right. And but it was, they say, an accurate number, and I'm prepared to believe it.
Yeah.
But the problem is, it's totally changed the view on future inflation.
Yeah.
And if the RBA has to move its rates to in response to the change in the expected inflation, it doesn't really have a choice.
It's part of, like, one of the things that has always been hard for an economist is to comprehend the structural change in the economy as it's happening. Now, I can remember many years ago interviewing Noel Whittaker, one of your wonderful Queensland colleagues. No, he's not with Morgan's, but he lives in Queensland. And he said, well, when it's a hot day in Brisbane, they all go to the cinema to get the air conditioning. And that was obviously a long time ago, but everyone's got air conditioning now.
Yes.
Yeah, and everyone's got fantastic heating. Everyone has a new home. Like the McMansions of the world have all mod cons. Is the demand unbelievably high compared to, say, 10, 20 years ago?
It's not a problem of demand, it's a problem of supply. That major electricity plants, such as in the Hunter, have been closed down and in recent years, and there hasn't been enough compensation for that supply coming from somewhere else.
Yeah.
I mean, it's not a problem of coal-fired supply or renewable supply. The problem is there just isn't enough supply.
Okay, so the Reserve Bank increases interest rates, and it takes a bit of pressure out of people wanting to buy houses.
Yeah.
The house prices come off the boil. Some businesses, like your bakery, they close down. Unemployment starts to rise.
Yeah.
So these are going to be the forces that will eventually reduce the demand to at least meet the supply, and therefore, hopefully by the second half of this year, inflation might be on the way down.
If you look at the Nauru, where unemployment needed to be to balance inflation, and you look at 20 years of data, that unemployment needs to be between 4.6 and 5%.
Yeah, we're three, aren't we now?
Yeah, so in the last year, we've come to believe that Nauru was fallen to 4 or 4.2%.
Yeah.
But that was an illusion. Let's say it was a political illusion because of subsidies for the electricity price, which go to cheaper electricity for a period leading on to the election.
Yeah.
And then, but economically that couldn't be sustained. And so what we'll get is with this higher level of inflation, we'll need to get unemployment to a higher level to stabilize it, but it'll be the same kind of levels of unemployment that we needed earlier in the century to stabilize it. Right?
Okay.
We've just been through a period of unexpectedly low inflation, which meant it balanced at unexpectedly low unemployment.
Okay. Well, Michael, whenever I used to interview another economist who I'm sure you'll remember, Dr. Stephen Keen, at the end of it, when he was always predicting doom, and gloom, I'd always say, gee, I hope you're wrong, Steve. So in your case, Michael, good friend that you are, I hope you're wrong as well.
I think we're going to have a recovery in commodity prices, which is going to bring recovery back to the Australian economy. So just as we're tightening up in one area of the economy, we'll have an expansion in another area of the economy. So I don't think doom is going to be the problem.
Okay, great stuff. Good to talk to you, mate.
Thank you.
That was Peter Switzer with Michael Knox. Now, to hear the full interview, make sure you join us at our next podcast. Click on the link on the screen below and you can hear the full interview with Michael Knox on the podcast. That's it for this week. Peter will be back in the chair next week. We'll see you then.